All right, I'm going to do another quick round of introductions here. We have Iain Barnes, Head of Portfolio Management at Netwealth. Howie Li leads the development and growth of the ETF business at LGIM. And MJ Lytle is CEO of Tabula Investment Management and was a co-founder of Source before. So one of the things, one of the functions on the BI screen, ETF Go, shows the flow. So I looked at it before coming today, and you can see the number of ETFs. So granted, a lot of these are cross listings in Europe, so put that caveat in there. But there were more than 8,000 listed on there, and that seems like a gigantic number. I picked on Lee, who is next to me, so I'm going to go to the other side and start with you, MJ, this time. 8,000. Are we at peak ETF, or is there still room in there for innovation?
So I think there are two things. First, when you count 8,000, you are counting a bunch of share classes. So the actual number of pure funds is more of 3,000 or something. We clearly have a long tail of funds, small funds, trying to prove value in innovation. Some will succeed, some will not. There's a natural cleaning process that goes on in the industry where you run funds. They're quite expensive and difficult to run. If you don't gather assets over a certain period of time, they will close. Some people look at the closing of funds as a problem. I think it's actually the reverse. It's actually good for investors that people are thinking dynamically about their product offering and the cost of their overall business. We are definitely not at peak ETF or funds or innovation in structuring in the financial services industry, because frankly the dynamics that are driving our industry are constantly changing, and the things that people want exposure to are changing, and then you need to package them and distribute them to clients. We are also learning new things all the time about where value comes from. So 10, 20 years ago in the equity space, we thought it was all about large cap, mid cap, maybe sectors. Now we're talking about smart beta factors, momentum, low beta, different ways of cutting the securities base in order to deliver value. So we will always be changing our minds on where value comes from, and we'll have to be changing our products to match.
Howie, I'm wondering, so MJ mentioned some of the sort of, popular upcoming trends, what have you. I'm wondering if you have sort of any guidelines, and I know this is kind of difficult because it depends on the product, but any sort of overarching guidelines when you're looking at new products saying, how do I decide whether this is a fad or a lasting trend?
Yeah, that's a very good question. I think just to follow on from what MJ was saying there, what ETFs are representing are increasingly more and more kind of precision tools. The expectations of the market has changed from what it was, say, 20 years ago. A lot of people associated, let's say, ETFs with standard kind of market cap benchmarks. But actually, that's really moving. Investors who are used to not investing in, let's say, beta or market cap indices demand more. And so, thematic is a good area to highlight. There was a slide up there on Bloomberg Intelligence talking about the growth of thematic strategies. And why is that? And for us, your question was, when is it a fad? When it is actually a long-term theme as it relates to, let's say, thematic investing. We get lots of questions from clients asking, hey, would you do an ETF in X, Y, and Z? Because this is what we're trying to play. A lot of those questions represent tactical kind of views that investors want to implement. Where we think is a fad, let's say, is, we think Donald Trump is going to do this. Donald Trump is in office for a period of time. Whilst he's whilst he's kind of talking a lot on the political side, in the space of 10, 15 years, that is a blip and perhaps maybe a shift in direction, but it's not going to be a long-term change. What we're looking for when it comes to themes is long-term foundational structural change that is disrupting a traditional, let's say, sector or industry. More to the point, and I'm looking at the traditional kind of index providers in the room from the panel earlier, is where are the tomorrow's sectors? And I think that's what we really want to see.
Iain, where are tomorrow's sectors? Can you answer that?
No, I think that's very interesting. I thought it was very interesting to hear about the previous panel about how they're thinking about innovation from the index point of view, because I think the financial industry is very good at creating products and then trying to build demand for them, and I think the ETF world has sometimes strayed into that area. So some of the thematic products are are challenging in terms of thinking about who's decided which, what is the component of a particular theme. For tomorrow's sectors, I think it's fair to assume that as different some of the business models in the tech world in the US sort of disrupt traditional industries, you can start to see those traditional building blocks of sector categorizations that a lot of people still think about. So, going long financials or something like that. I think that there's ample scope to try and do that a little bit more smartly. But for us, the starting point is always going to be core building blocks and investing efficiently as possible.
Right. I mean, you still have that legacy of more traditional asset management, surely. So I'm wondering, with that view, looking at what ETFs are coming out, if there are any trends that concern you, or maybe clients ask for them and you very much so say that doesn't sound correct.
Well, there are certain things that our clients trying to take a sort of more institutional approach into the sort of sleepier world, if you like, of wealth management. There are some people there's clients who have been burnt by some of the thematic stuff that they've seen before. Like some people have been invested in leverage products or something. So that's always a first point of call to us. They ask whether is there any leverage in our strategies, and so we take that into account and certainly don't do that. Another one in the UK is there's a big deal about liquidity at the moment. On the previous panel, I heard talking about one of the leading fund managers there. That's something that I think is going to be more and more pronounced as the economic cycle sort of goes through. And it's interesting to see how different product creators are responding to those challenges, because I think that's always going to be the area where there's potential for disappointment for clients, where there's something going on in an asset that they own that they don't understand the drivers of.
Yeah. Let's definitely talk about this, because liquidity is such an issue. I mean, we've had liquidity crises at GAM, Woodford, and most recently H2O. So this is certainly an issue. MJ, I feel like you have a thought or two about this.
Liquidity crisis at H2O.
Or maybe not that specifically,
No, H2O, right? Water.
Oh, yeah, love that irony.
I think worse than irony. Look, there are a couple different things here. One is liquidity. Where does it come from? How do you tap into it? The whole ETF structure, the UCITS structure is built to look at the liquidity of underlying assets and deliver it to investors. The ETF structure, specifically with a daily liquidity on the primary side and intraday liquidity on the secondary side, is built to deliver liquidity to investors. Clearly, things can only be as liquid as their underlying in a stressed market. So you can have index products that trade more liquidly than their underlying in good markets. But when markets get stressed and you shift to either everybody selling, then you have to look at the underlying. And that is, if you build an everyday mechanism, you will gain liquidity, but you only gain the liquidity that's in the underlying. If I could just touch, though, Danny, on one thing that came up earlier, yes, which is around innovation. And we asked the question of where is innovation coming from? And our previous, one of our questions to the audience said, where is innovation going to? It said fixed income and alternatives. And then we had our big index providers up on the stage, and we asked them what's going on. They said, oh, we just bought a bunch of fixed income index providers. So you've seen a ton of M&A in the fixed income index space with the sale of Citi to FTSE, the sale of Barclays/Lehman to Bloomberg, the sale of BAML to ICE. Basically, all the big index businesses in the fixed income space, which used to be independent, have now been bought by previously equity-focused index providers. What does that tell you? Well, it's not people getting up on a stage and saying, I believe that this is the opportunity. This is people spending billions on where they think opportunity is. So that's a pretty good indication of where the opportunity is.
Yeah. I mean, Howie, do you think that this is where the innovation, where the future of ETFs, it's going to be heavily fixed income? Does that make sense to you?
I definitely think there's a lot to do in fixed income, mainly because the universe is so much larger. And to my point earlier about precision, we find, especially in different markets, whether it's the Italian market or the UK market or even the local market here, appetite towards fixed income is quite different, and people are looking for those precision tools. If you kind of rewind and look at what products were available from an ETF perspective, say 5-10 years ago, they were a little bit more basic. But then all of a sudden, the market wanted things to be broken up into duration buckets. Then all of a sudden, people want to see not just investment grade, but some high yield in there. And that is a sign of, I suppose, investors wanting more and more precision in their products. I just want to kind of touch back on that liquidity point, because fixed income and liquidity, and perhaps even alternatives and liquidity, is always going to be a question. I think what's really important to understand is, ETFs aren't trying to do anything new in terms of the underlying strategy. A lot of the asset classes that we're talking about, the opportunities, come from assets that already exist. It is a UCITS vehicle. Most investors in this room are probably used to buying mutual funds, unlisted. It just so happens ETFs are listed. And I'll give you a very interesting example. We had, working with some clients, they wanted to sell, and we do have investors that want to buy and redeem at the same time. They had a pretty big ticket that they wanted to redeem, but they wanted a nice, tight transaction cost, but they wanted to do it on one day. Now, the market was fine, no liquidity issues. However, what they wanted to do was execute on a single day. Our portfolio managers knew that if we spaced the selling of the underlying asset out over a series of 3 days, there would be a better transaction cost or experience for the clients. And what happened there was unfortunately, I'm not sure if the market makers or flow traders still in the room, but that is a business that buys the essentially ETF off the client at the cost that they want to see, on the single day, so they get out when they want at the price that they want to get out at. And in the background, we're working with the APs or the authorized participants and market makers to then slowly sell this down, so to make sure that, one, we're not disrupting the market, two, we're able to just keep transaction costs as close as possible. So there is that kind of additional layer of liquidity that's really helping both the fixed income and the alternative side.
Can I ask something like that? Do you think that, we've spoken a little bit about innovation of new products, and everyone's aware that there is this tail of ETFs. Do you feel as though the tremendous job, frankly, that some of the APs do on trading those big chunks of assets and how they treat different ETFs when they're able to offset the underlying components when they're trading? Do you think that is going to prohibit a level of innovation in terms of making it a higher hurdle for new funds to survive, prosper?
No, I don't think so at all, because what the APs and especially the market makers do is run a very sophisticated business to understand inflows of outflows, not just of ETFs, but in terms of the kind of the underlying securities, whether it's bond or stocks. What is really interesting about the ETF world is that you can have these transactions that take place on the secondary market. And what we don't want to do is disrupt the underlying market because of that trading activity. So if there is an opportunity to, say, net off a trade where you've got an interested buyer on one side and an interested seller on the other side, they kind of connect. They make that transaction. They're not or the portfolio managers aren't having to buy or sell stock, and therefore they're not incurring, let's say, kind of the tax for not capital gains, sorry, stamp duty. They're not having to incur trading costs, and you've got an experience that works for both investors without kind of inhibiting the underlying market. So I think more products would be good in that sense.
Well, I think, Iain, to get at your point, if you're creating ETFs, you have to be in partnership with people who are market-making ETFs, right? Because effectively what you do in this market is split the product in half. So the asset manager is responsible for creating a product and doing the primary creates into the secondary market. But the secondary market is supported by a bunch of independent market makers and investment banks who are not necessarily connected to the issuer of the products. Now, there's a very positive side to this post-MiFID II. It means that an asset manager can significantly reduce the number of counterparties that they face, and that's a bit, onboarding counterparties in a MiFID II environment is very intensive. But on the flip side, it means that you're reliant upon the execution of a secondary market maker for the client experience, because the client's not trading with you, they're trading with somebody else. And so you can't look at the secondary market makers as, oh, they're over there, good luck, let's see how that goes. You have to be in partnership with them. You have to work with them in a very integrated way. You have to be talking to clients and understanding how they're going to execute their products, their trades, and helping them get that done efficiently. Because if they don't, it's going to reflect on you, because it'll reflect on the overall performance of the asset that they own.
And the experience for the investor. They are very key to the ecosystem of the ETF market.
But one of the things, though, I wonder if this relationship has really been tested if there's a fire sale, if there's a crisis. I mean, Iain, do you feel comfortable that, holding any sort of newer fixed income product or just one of the standard ones that have been there around for a while, that when there's selling pressure in the market, that these products, the relationship with the AP, it's still reliable even in that environment?
Well, yeah, I think so. I think that the great thing, or one of the great things that ETFs have done is been able to sort of embed themselves within the broader sort of investment infrastructure. So a lot of the investors now in ETFs are not the people who need that small unit size. They are institutional owners who are looking for for the first layer of liquidity. And to my mind, what you often see in periods of volatility is just price discovery from supposed less liquid asset classes. So you always see, in the on Bloomberg News when you have big days and the big flows going into some of those large credit ETFs. It's not just individual people panicking. It's people offsetting all of their different allocations through that instrument. And I think as long as whether the growth of ETFs actually changes the sort of ecosystem of how markets behave is maybe a different question, but I don't think it's necessarily something that you need to worry about a particular ETF blowing up because people are able to manage those the different exposures within them.
I think the reality is ETFs have existed for almost 3 decades. There have been a lot of crises during that time. There is not one ETF that has blown up and failed to deliver on its liquidity.
Can I just say, what about throwing in there, for example, some of the VIX ETFs?
Well, a couple of points there. One is they weren't ETFs, right? They were ETNs.
ETNs, sure.
But they did deliver. And in the example of the velocity shares, Credit Suisse, what happened was it was a levered exposure to a position on equity volatility. It did exactly what it was supposed to do. It was unpleasant for investors, but anybody who understood how the product worked, it did what it did. It was later closed because Credit Suisse made a decision post that experience. They would wind down the product, but the product did what it was supposed to do. It never closed. It did not break. So I think that's super important to understand that we've gone through tons of crises. The second thing is around what's inside and how liquid it is. Daily transparency, PCF files, which is what the market makers see, the detailed what the fund owns on a daily basis, and then having that on your website, that's a level of transparency that doesn't exist in traditional funds. If you want to know what's in your traditional mutual fund, you usually have to wait for quarterly statements. They're usually delayed by a certain amount of time to be prepared, all understandable, but we've set a totally different bar in the ETF space of having to, on a daily basis, update our websites with all the ownership of an ETF. So if you start to have a concern, what's actually in here, you can go figure it out.
I want to talk about transparency, though, but another aspect of it. So the aspect of when you have a lot of these innovative ETFs, be they smart beta, anything that's sort of quant-based, a lot of times is what you get is you see these back tests. You see the ETF outperforming. It looks really good. I mean, is transparency, Iain, strong enough there when it comes to the construction of these ETFs? Do investors really know what they're buying into for a lot of these newer smart beta rules-based ETFs?
Well, so they should be able to. It's a question, I guess, when you're building more niche products, then it is incumbent on the buyer to make sure that they understand them. And to MJ's point, the ETFs that have gone wrong, the ETF just happened to be a wrapper for people buying something that they didn't necessarily understand. It behaved as it should do. I think they're a massive force for good in terms of raising the bar of transparency across the industry, and from our point, it ties very nicely with MiFID II, which has just been great for us as individual clients in the UK are now seeing their financial statements come through with full transparency, and a lot of them are not liking what they're seeing. So transparency on costs, where all of the expected trading leakage is going to come from, as well as inherently being able to see exactly what you own and explain it in a way that people can understand is fantastic.
Right.
I think, Iain, you make a great point there. I mean, the transparency is such an important part of our industry, and we're actually used to, over the last 10 plus years, of people shining a light and expecting to see everything. Now, that's not the same amount of scrutiny that, let's say, the mutual fund industry or indeed the active community had to face. And so to go back to your original question there, Danny, about the back tests, how reliable are back tests, et cetera. Indices, especially under UCITS, they have to be transparent. It's on a website. You can see exactly what the rules say. You can see, let's say, there's filters, what stocks make it in, what stocks make it out. And so there are sets of rules that essentially the backtest is just a representation of what happened in history based on those rules. You can't tweak it, you can't meddle with it. It is just the backtest based on those rules. Now, if you were to look at a portfolio which is not transparent, or an investment strategy that's not transparent, or indeed discretionary, I think that's where track record becomes a lot more important, because in the active side, you can change your mind. You can change your investment process. But when it's in a set of rules, back tests reflect what those rules do. And I do encourage investors to put scrutiny on that piece.
Yeah, I mean, just to take that point a little bit further, Danny, part of what you're saying is, should we buy anything new, right? Because anything new doesn't have a history.
Right.
How long should we wait? And who's supposed to buy it until we buy it, right? So if you want a history, somebody's got to put money into it. If you have an active strategy, there is no ability to go backwards and say, what would George have done 10 years ago? George was still in nappies at the time, right?
At that stage of life.
At that stage of life. Whereas if you take an algorithmic strategy, we can argue about fitting of algorithmic strategies to market environments. So obviously, when you create an index, we say it's a very standard index, i.e. it's a market cap index in the equity space, and we haven't applied any particularly differentiated logic to it. And then we say, okay, well, we're going to take all these names except if X, Y, and Z happens. Okay, fine, but we're telling you exactly what the algorithm does. And when you backtest it, clearly environments 10, 20, 30 years ago are not what they will be 10 years from now. But at least you know that process. There's a disciplined process. So the one benefit that you get versus an active strategy is you can at least take it apart and come to your own conclusions. It doesn't mean there aren't going to be wrinkles, and it doesn't mean there aren't going to be changing market dynamics, and you're going to go, damn, I should have done, right?
Yeah.
Historical performance and kind of what's in the future, I think that's a really good point. We touched on ESG and sustainability investing, and that topic wasn't as prominent 10 years ago, right?
Sure.
And so you can't look at ESG investing based on historical performance. We now have a appetite of investors, especially here in this country, which are really driving the investment in companies which are doing positive good and change. And that's going to reflect in some, that market shift or regulatory shift or whatever you want to call it. That's going to reflect how future performance is going to look like. So us putting together, let's say today, a ESG-focused strategy on people who are improving their kind of corporate governance and their environmental and social impact, that's likely going to mean we're going to see those returns in the future, but you can't see that in the past.
So if I can pick up on the thread of some of these more machine learning based things, I want to take it to our poll for this one and see if ETFs are transparent enough to even answer this question. It sounds like they are, so let's see what the audience says. It's, do you consider artificial intelligence an innovation in investing or just marketing? All right, so I mean, especially if you can look at the back test, that presumably helps you answer whether it's marketing or investing. I feel like the skeptic journalist in me thought marketing would be a little bit higher. But as someone who loves quants, I'm happy to see investing is a little bit higher. Iain, thoughts? Or is this what you would have expected? Does this large majority in investing surprise you? Or
So I'm surprised at the magnitude of the difference there. But no, I think there's going to be some value of AI within investment markets. I think it's very difficult to tell who is going to be the overall beneficiary of that, and how different developments are going to interact with each other. I mean, from our point of view, it's also a particularly big deal, in terms of how clients think about investing their money as well, just in terms of what they expect from their wealth manager, but also how they expect to be able to interact with them in the future. From the investment side, I think it'll all become transparent in 5-10 years. We'll read about stuff on Bloomberg of amazing things that people were doing right now. It just takes a little while to filter through.
I'm quite glad to see that pie being on the investing side, because I think I was like you, a few more skeptics in the room. What I would say though, and this is what I suppose the attention needs to go back to data. Data needs to be there and needs to be good in order to drive artificial intelligence in investing. And it's great because it helps you process all this information that's coming out here. So from an investment design perspective, it's a very helpful tool. Where I would probably be a little bit more skeptical from an investment design perspective is where you're using, let's say, data scraping technology, and you're just searching for keywords or
every time Trump tweets.
It could be Trump tweets or things that we've seen, people scouring through, whether it's financial reports or patents or patents which are made that use specific words. Now, you and I can put anything into a financial statement or a patent to say, well, we have machine learning in here. So if you start data scraping anything that says machine learning and say, hey, look, this is the investment opportunity, you might get some noise in there because there are people who understand what makes their marketing side look and sound good in financial statements or in patents.
That's the thing. You don't know who's doing it well.
Yeah, correct.
So there are going to be some people who end up very disappointed with poor execution, which I think is important.
Well, look, there's no question. More and more information. The only way we can process the information, to analyze the information, is by using technology, right? If somebody said to you, yeah, I only do this on paper. I do all of my analysis on bits of paper on my desk. I don't believe in computers. I don't believe in spreadsheets. You'd think they were nuts, right? On the flip side, the question is where you split this between analysis and decision making. And what artificial intelligence suggests immediately to most people is that the decisions are made by the machine. And I think that's a little bit more skeptical. Well, I'd be more skeptical about it. And that's around where does the human being add the value? And where does the more creative, I mean, when you think about how our brains work and so on, there's a creative element and there's an analytical element. We are able to turn the analytical element into programs and what-if statements. It's much harder to recreate the creative side within those. So I think everyone agrees the analysis, more and more of the analysis has been done by more thoughtful analytical programs. The question is the decision making, and I think that's where the jury's out as to where you draw the line.
I mean, one thing that I kind of struggle with in talking about AI ETFs is AI, I mean, it's in machine learning. It's such a huge umbrella. It means so many different things. And one of my favorite things I've heard someone saying, for example, if you're using AI to rejigger sectors, that it's the equivalent of taking a sledgehammer to a wall when all you're trying to do is hang a picture. I mean, I'm wondering if there's any of that aspect when people are using AI when they really don't need to be.
It's certainly a nice term to be able to use on marketing. So for the 25% of the room, you're probably seeing some of that. But actually, I think, MJ, you make a great point. There's a difference between analysis and decision making, absolutely. I mean, the question there is, does a decision need to be made by the machine, or actually should the data come through, and then for actually people to stand in front and say, does that actually make sense, and actually make a judgment call? I'm very much of a believer that the financial industry is never going to be 100% automated. You facing your clients, that's still a very important part of human interaction. I think there's going to be a lot of augmentation that helps the financial industry, but full automation using artificial intelligence and just completely cut out humans, I don't think that's going to happen to this sector industry.
And I think if you take the sledgehammer to the wall, Banksy would say you've created the art and you don't need the picture anymore.
I love that. I love that, MJ. All right, well, another great point to end on. This is fantastic. Well, everyone, please join me in thanking our panel.